Welcome back to the Family Capital Podcast. I'm your host, Jared Machin, along with my co-host, Justin Brownlee. And this week, we're going to do an introduction to family offices. We're going to talk about what a family office is, why they exist, and then we're also going to dissect JP Morgan's guide to the family office, their family office report that they published for 2026. Justin, before we kind of get into the mechanics of all this and talk about the report, what even is a family office?
Well, I think it's important to first state that if you do an inspection of 10 different family offices, you are probably going to find 8, 9, or 10 very different strategies, very different structures, very different kind of employment rosters. So that is the very first thing worth mentioning. There truly is not a textbook. There is not a consensus on this is the right way to start, construct, oversee, and manage a family office. So I do think we will see that throughout this report. But what is a family office? I think it's really just a company dedicated to passing down wealth in a thoughtful manner. What would you define it as?
Yeah, I like that. Slightly less existential, but I would say an office dedicated to the holistic needs of one family, right? So if you think about what we do at Brownlee Wealth Management, we're a registered investment advisor. So we help with comprehensive financial planning, but the investment piece is kind of the core of what we do. In a family office, it's more of, hey, how do I help with the financial, the tax, the estate, bookkeeping, bill payment, all of those things. So it's really an office or just resources that are dedicated to serving the needs of one family. So Justin, kind of thinking about, hey, that's what a family office is. Why would somebody decide to start a family office? And is there like an amount of money where it makes sense to do that? Or what determines whether I hire third-party professionals to do that versus start up a family office?
A couple things come to mind. I do think, Jared, it's very important and helpful if your very first thought with family office creation, I think your very first thought should be, I should not do this. Thought number one should be, I probably should not start a family office.
Why is that?
I think that there are a number of ways to accomplish everything that you want the family office to accomplish in a more efficient manner. And so I think starting with that, though, what it will produce is a sharper, more clear family office. Once you do create it, I think you're going to really dial in, how do we make sure that we are executing exactly what we want here? So I think it's just a helpful framework to start with the thought that I probably shouldn't start a family office. But I think another thought that comes to mind, Jared, if we just think about wealth at every level, so this JP Morgan family office report, I want to say that the median family of all the families they surveyed had a net worth of like $1.5 billion. And so, a lot of people might listen to that and think, well, I don't have $1.5 billion. Why is this relevant to me? Now, I do think there's truth to the idea that if you want to pass down any amount of wealth, if you want your children to inherit wealth in a thoughtful manner, I think it's really wise and worthy of your time to look at what are the wealthiest families in the world doing. But, I think also bring it back. Why does any family at any level of wealth begin to delegate some of the management of their wealth? And at the end of the day, whether it's $4 million, $14 million, or $14 billion, you begin to ask the question, is delegating it going to provide a higher level of return? Is it going to provide a higher level of care? And ultimately, will the value exceed the cost that I'm incurring to pay for it? And so I think those are some of the starting kind of reasons as to why you would go down this road. But what do you think, Jared?
Yeah, I think I like your first principles idea of like family offices is the most intensive, capital intensive, energy intensive to start up. So like that's probably not your first stop as you think through, hey, what do my family and I need in this next season? I think kind of two defining questions. I think one is how difficult is my lifestyle to administer, right? Like if I'm managing 5 homes and I have 20 different trusts and my kids are sharing time between each of the houses and I rent these out, take advantage of the Augusta rule, whatever it is, right? Like in paying bills across all those entities. If there's like a baseline amount of what I would call lifestyle complexity, right? That's probably one of the launching points of thinking through, okay, I need resources to help me manage my life because there's a lot of moving pieces here. I would say the other thing, kind of like what you talked about, right? The dollars are so big that the quest for superior investment returns makes a meaningful amount of money, right? So like it probably doesn't make sense to have full-time investment staff if I'm managing $50 million. But if I'm managing $1 billion, even 0.75% more on an annualized basis takes you in a different stratosphere, right? And so I think like those are the two buckets I would think about of like when people might decide it kind of makes sense, depending on how you think about the answers to these questions.
Jared, I think there's another dynamic too. I think a lot of people at every level of wealth might have this thought that I generally know the direction that I want to go in. I know how to manage my estate. I know how to manage my assets. But what they might have a hiccup on is what happens when something happens to me. And so I think a lot of family office creation is started from this idea of a desire to build a vehicle that will make great decisions beyond you. And so I think, that is, if I were to just really summarize why someone should do this, you're wanting to create a vehicle that will ensure that great financial decisions are made past yourself.
Yeah, and we'll get into that in the report, but I honestly think that's a really good focus. But as you look under the hood, there's kind of a different focus and a push and pull. So we'll talk about that in the report.
Is that even being accomplished? I think we would both look at the data and say probably not.
Probably not. Yeah, absolutely. So to just to kind of add some definitions just quickly. So if you think about, like Justin said, if you looked at different family offices, there are lots of different structures. Single family office is really all employees work for the family, right? And there's also what's called a multifamily office approach, where you say, hey, the employees might serve several families, but generally the client to advisor ratio is meaningfully lower than the hundreds that the average wealth manager manages, right? So there's kind of a wide spectrum of, hey, I can have all these people on my personal payroll. I could tap into, outsourced professionals that might work with several families, but the ratios I get much more bespoke, higher level service, or I can kind of go to a full service firm where I'm one of hundreds. So there's really different flavors. And in terms of like, okay, who is in a family office? There's 3 buckets of personnel. There's family members, active and inactive, right? Because legacy is something that happens. So, it's not just who's presently in it, who has been or will be in it is also part of that equation. There's employees of the family office and then delegated professionals, right? Even if you say, hey, I'm going to set up my own family office, you depending on how your family office is structured, you might not need an estate planner on retainer full-time just working for you and your firm, right? So even if you go down the family office route, there's likely some ancillary services where you have a delegated third-party professional. But those are kind of the different flavors of family offices and the personnel mix of what might be in it. And again, that will structure wildly depending on what you or your family is solving for.
Absolutely. I think that's well put.
All right, Justin, let's get into the study. So I want to set the table here of like, what is this study? Because, JP Morgan does this. It's a global study, and we're going to link to it in the show notes. So we'd love for you to kind of take a look at it, hear what you think. So it's 333 family offices, all JP Morgan clients all around the globe. And on average, each one is responsible for 1.6 billion, right? So that's very interesting that, a lot of these billionaires have a lot in a family holding company or operating company. So their liquid net worth might be a fraction of that, or how much they can actually have investment discretion of. But so we're talking billionaire families. So I'm curious, Justin, like you mentioned this, but before, so that's kind of who this study is for. You touched on this, but I want to drill back down into this. Why should you care whether or not you're a billionaire and like if you're not thinking about family offices at all? I think there's like loads that anyone can take from this. Why should anyone care about this, even if you're not in family office land?
I think that really hits to the core principle of if you are wanting to pass down wealth, if you're wanting to have a vehicle that will make great financial decisions for your kids or other family members, that's why you care. So you may not be at a position where you want to start it today. And Jared, we can get into the weeds on this. I think it's very fascinating to begin to ask the question, does family office creation happen while the family's core business is still owned and operated by them? Or is it mainly triggered by a liquidity event where now there is enough liquid assets to go down this road? But I think that's a little bit of the start of it.
Yeah, I totally agree. I think, we're trying to introduce and suss out this idea of capital is multidimensional, right? Capital is not financial. It's not just financial. It's relational, it's spiritual, it's intellectual, it's communal, right? Like all of those things. And everyone, whether you're a billionaire or not, is in the capital allocation business, right? Full stop, regardless of how much money you do or don't have. So I do think there's a lot to learn from the families that have the most money and spending the most energy and time throwing stuff at this problem. There's probably things we can learn, right? Like I can't have a family office, but what are the risks these families are solving for? How are they spending money? Where are they adding value? What governance structures do they have in place to pass down all these ideas, right? Like you can use this blueprint and adapt it to your personal situation, but like we are all in the capital allocation business, and these people have tons of financial capital and are thinking about all these dimensions and managing a lot of entities and complexity. So I think that's huge. So Justin, before we get into the study, like there's probably some people listening that are like, I don't really care about family offices. I'm not going to start a family office. Like, I think there's loads of wisdom in this study and things we can learn, but why would you say people should care about this, regardless of whether or not you're thinking through these questions of what's a family office? Do I start one? Does it matter?
I think we agree, Jared. Everyone is in the capital allocation business. Everyone has to decide, how am I going to allocate my resources, my time, my focus, and how am I going to pass this down to my children? And so at any level of wealth, I think there's an enormous opportunity to look at, what are the wealthiest families doing? What are they doing right? What are they doing wrong? And as we've already alluded to, there are so many differences. If you look at 100 different family offices, 10 different family offices, they really don't look the same. And so I would argue that you can learn a tremendous amount more by looking at a study that's, interviewing hundreds of families rather than just looking really in depth at one.
Yeah, yeah, I love that. Right, I think like us as an industry, or just like us as in the world, we're hyper fixated on accumulating wealth, not preserving wealth. Right, and so I think like family offices, like they're already wealthy, right? They're in the wealth preservation business, and I think that's something that people don't spend enough time thinking about. Right, it's like, how do I get wealthy? No, it's how do I stay wealthy, and how do I pass down my wealth, and what does wealth even mean? So I think that's like a really interesting kind of focus, and I don't think we as a society spend enough time and attention on that. I also think this is, it's wild because I said this earlier. It's 333 family offices. There's an estimated 8,000. So surveying 333 of them, that's like statistically significant, right? That's like doing a survey of Americans and surveying 14 million of them, right? It's that's huge. And like I totally agree. Like everyone's in the capital allocation business, and these enterprises, these family enterprises are throwing money at, they're throwing the most dollars at solving these problems about wealth accumulation and preservation. And so like, again, we don't have that amount of money to throw around, but the ideas, the principles, we can size them to whatever our economic reality is. So I also think it matters, right? Like JP Morgan is like one of the biggest private banks in the entire world. So when one of the biggest banks in the entire world publishes a report on what their biggest clients are thinking about investing in and spending their time and attention on, that's just worth listening to. It'll be indicative of where the focus is going forward: product innovation, energy, new investment classes, right? Like all of this is kind of a lens of, hey, where are things headed? Because, ideally this stuff trickles down to people at all levels of the wealth rung.
Absolutely. Well, shall we jump into the study?
All right, let's get into it. So, I want to start here. And again, we'll have this in the show notes, and we'll have kind of pictures on YouTube. But if you're listening, we'll kind of talk you through it. So if you look at demographic data, it looks at, I'm looking at page 7 here, and it looks at the average amount of wealth of each participant. It's $1.5 billion. $1.6 billion. It looks at family office age. So 27% were started in the last 5 years, another 27% in the last 6 to 10 years. And then there's a minority, so 39% that were 11 to 20 years old, and 27% that are more than 20 years old. Justin, I'm curious, as I spout those numbers out to you, I want to keep talking about those numbers, but as I just give you those two, what stands out to you?
Biggest thing that stands out to me is how early we are, early innings in the family office space. So vast majority of the family offices surveyed and the family offices currently in operation are new. They have not been around forever. Now, Jared, I think there's a couple things that come to mind here. You don't need to have a family office that lasts for 200 years. It's certainly neat and incredibly fascinating when you do run into that. But the purpose of the family office, it doesn't have to be that this entity will continue to exist and will continue to serve the descendants 140 years later. But at the end of the day, this is a very new study. And so the amount of family offices that have been created in the last decade, I mean, it's the majority of those surveyed. And again, just like you mentioned, this is a really comprehensive survey. And so I think the biggest thing that sticks out is the idea of operating a family office. It really is a new thing. And it's becoming more and more mainstream. Jared, I would argue that's because of the incredible, unprecedented amount of M&A activity across every industry today. At the end of the day, it is hard to have the liquid assets to start a family office if you still own and operate your business. But we have seen more families in America and abroad get liquidity events in the last 20 years than really any time in history.
Yeah. Yeah. I mean, I think the big takeaway is this is early innings, right? This is being built in real time, right? That like there's no precedent for what's taking place. The majority of family offices are less than 10 years old. So I think, 20 years is going to go by and we're going to learn a lot. And this report's probably going to look very different because everybody is learning together because the proliferation of family office is just wild and how young these are. It's just such early innings, which is really exciting. It just means, you need to kind of hold this loosely. This isn't the fact. This is kind of where we're at in the cycle. Justin, I want to talk about, the number of family members because it kind of alludes to this newness component. The number of family members that they're serving, 31% of the family offices surveyed served 1 to 4 members. 30% serve 5 to 9 family members. 16% serve 10 to 14 family members. 17% serve 15 to 29 members, and only 6% serve 30 plus family members. Man, I mean, again, over 60% of family offices serve less than 10 family members. Does that surprise you?
On the one hand, it does surprise me because, again, it gets us at this idea that most of the family offices that are being operated today are relatively new. So there just aren't a ton of family offices where 3 generations are involved and active. But Jared, I also think it gets to this idea that you don't necessarily have to have the purpose of a family office being, hey, this is going to still be operable. It's going to still be the governing entity 4 generations later. And again, wonderful if it does happen, but it's incredibly hard to pull off. I would say it a different way. It's completely reasonable for families at some point in the family office journey to come to the conclusion that this has been wonderful. It's been a good thing, but we at this point could separate and go our separate ways. And so I think there's some of that dynamic that it's new and some of the dynamic that when a family office has been around for 3 generations, eventually, well, the different families may go their separate ways and do different things.
Yeah, it's honestly just a math thing, right? The number of descendants. Right, like the odds of all that attention, energy, capital being consolidated in one place diminish as the family branch widens. Right, and again, there's probably some way to keep the continuity while respecting different generations' preferences. I also just think it's where we are in the life cycle. Right, if I've had my family office for less than 10 years, and I have my liquidity event in my mid 60s, I probably don't have great grandchildren yet. Right. So like, it's just a problem. I'm not thinking about it. And in the first 10 years, right, I'm just trying to figure out how to get my arms around optimizing for this generation. Right. Cause it's really early innings. So I don't think it's an intentional, hey, I don't want to support the next generation. It's just where we are in the life cycle. I'm building the infrastructure to support the existing generation and maybe some ancillary family members that are involved in the day to day. But we're not there yet.
I love what you said. It's where we are in the life cycle. I would add, I think we could do an entire podcast on the topic of, well, the family office has been operable for the last 20 years, but now there are 14 different great-grandchildren. They might live in different countries. They might live all over the country. They might be in completely different industries. It may not make sense for every one of their individual family units to still be connected in the same entity.
So yeah, I think again, early innings, it'll be fun to track. And it'll, in 10 years from now, we'll do this, we'll rehash out this report and it'll look vastly different. I want to talk about page 12. And I want to take a page out of the US playbook. Again, they bifurcate investment allocation. They look at the global study and United States. I kind of want to focus on United States because that's where the majority of our listeners are. And I just want to do a brief run through how are these family offices allocating money? So 39.5% public equities, 34.3% private investments, which is a hodgepodge of stuff, 10.7% fixed income, 7% cash, 5% hedge funds, 1% commodities, 1% art, 0.5% other, 0.4% crypto. Justin, does any of this surprise you?
First thing I want to say, if you have $10,000 or $10 billion, the core foundation of your asset allocation should probably be centered around public equities. So something that we have talked about several times before, when you are investing in the stock market, you are not investing in a nebulous, risky, crazy gambling situation. You are owning the greatest companies in the world. And so as an investor, if you can own the greatest companies in the world and own them for 40 years, you are likely going to do extraordinarily well. And so even at the highest rungs of wealth, we are seeing that the largest portion is still devoted to public equities. In other words, you don't graduate from owning the greatest companies in the world.
Yeah, you never outgrow buying stocks, right? Like the stock market is the best passive wealth accumulation vehicle that has ever existed. And again, there's a lot of different asset classes represented, but you never outgrow it, right? And so like even these families have a large allocation to it, right? Like the next biggest rung is private investments. And again, there's a bunch of different varietals of that. We got private equity, secondaries, growth equity, private credit, real estate, right? Like private investing is like, it's kind of a catch-all for like a bunch of different buckets. Does anything about that number surprise you that that's the second biggest?
I think the most interesting question that I would want to ask there is just, what is the life cycle of the family surveyed? How many of them are still retaining kind of a managing stake in the original business that created wealth? Jared, I also want to repeat something you said several minutes ago, and that is a lot of attention is devoted in America to this idea of how do I create wealth? How do I start my wealth journey? How do I build? How do I create wealth? Not as much attention is given to how do you preserve wealth. And I think that is very indicative of the public equity conversation. If you are trying to get really wealthy in a 4-year time period, passively owning stocks is probably not going to get you there. If you're trying to preserve incredible amounts of wealth over 40 years, owning the greatest companies in the world in a passive manner is a wonderful way to get you there.
Right. Yeah. I would actually go as far as say the playbook for accumulating wealth and the playbook for preserving wealth are at odds with each other, right? To accumulate wealth, you really need to take risk, right? And own a company and really go all in on one idea.
An outsized, concentrated bet in one company.
Right. Exactly. That same logic applies to building a resilient portfolio. Once you've had the liquidity event, creates big asymmetric risk. So I think those ideas are at odds with each other. I think like thinking about private investments, like I think the average listener shouldn't say, oh, I need a third of my money in private investments, right? Like if you think about privates, manager selection and access matters, right? Because different people get exposure to different deals. And like you need full-time people to source this, to identify the opportunity set, and to get access to deal flow, right? Like if I go to the stock market and buy NVIDIA and you buy NVIDIA, we're buying the same stock. Right? If you and I go to invest in private equity funds, we can have drastically different outcomes depending on which managers we pick, which vintages we pick, and how much we allocate and when, right? And so there is I like the idea of having this much in privates because again, there's a lot of different flavors of privates, but this is one of those things where the range of outcomes is wider than public equities and who you have sourcing these deals, which deals you're investing in, and how you're building a diversified portfolio across these deals really matters.
And that leads into Exhibit 4. Really interesting when you begin to study which portfolios had zero or what asset classes had 0% allocation across families. And so 89% of families surveyed did not have any exposure to crypto. That's interesting. 58% did not have any exposure to private credit. The entire list is very interesting when you look at, okay, who owns no gold? Who owns no transportation, infrastructure, and related assets? And some of these are surprising, and I think some of them are not surprising.
Yeah. I mean, it's a testament to everyone is different, and it's kind of a function of, hey, what are you solving for, and what is my investment philosophy? One thing I will say in the allocation piece is 7.1% in cash. I wonder how much of that is private investments where the capital hasn't been called yet versus, hey, this is a strategic bucket of money where, hey, I'm using this money to live off of, or I'm going to opportunistically deploy it, right? So that could be a bucket of money that has been spoken for and it's going to be part of private investments, or it could serve a bunch of different purposes.
And Jared, there's an element where I almost think 7.1% in cash is smaller than I expected.
Yeah.
Because, at the end of the day, if you're a family and you own 4 different homes and have an expensive lifestyle, well, you need a tremendous amount of dry powder just to pay for living expenses so that you're not selling investments at the wrong time to pay for living expenses. And then, great point, capital calls and a million other reasons to hold cash.
Yeah. Justin, I want to talk about the risks next, or the risks that these family offices identified, because it is interesting. Like, we're talking about their asset allocation, and then, okay, what are they thinking about? And the top 5 risks cited in the United States, 64% said interest rates, 61% said inflation, 61% said economic growth, 57% said geopolitics, and 56% said asset valuation. I'm curious, are those the 5 risks that you would expect to see? And is there anything about how family offices are allocating that may be at odds with the risks they've identified, or does that track?
Risk is often a function of time frame. And so, we say quite often that your time frame should dictate how you invest. Well, your time frame can also dictate what risks are most relevant to you. And so geopolitical risks, liquidity risks, interest rate risks, those can have a tremendous amount of risk in a short time period. But ultimately, I think all of these families are trying to allocate in such a way where they're going to compound wealth over 20, 30, 40 years and beyond. And sometimes it can be really tough to assess what is my greatest risk that will appear 15 years from now.
Yeah. Yeah. It's also, right, like that's a testament to building a diversified portfolio, right? When we talk to clients about investment management, we're not trying to build the best portfolio in a certain market environment. We're trying to build the most resilient one, right? I'm not trying to hit a home run. How do I get on base in as many different economic environments as possible? And if you look at the underlying diversification of those balance sheets, kind of makes sense what they're solving for. I did think it was funny on that excerpt. It said, in light of inflation being 60% saying inflation was a big risk, the allocation to gold has 2x'd from 0.9% to 2%, right? Feels like a rounding error.
Right.
Right? Like if I'm actually scared of inflation, it's funny because like Bitcoin is the digital store of value. Digital gold and actual gold are, in both of those asset classes, are either getting no allocation or pretty much none. So, I would be interested in kind of a follow-up question of how were you combating this? Interest rate risk being a high thing, it makes sense to see an under allocation to fixed income, right? Because if rates rise, my existing fixed income becomes less valuable because I can now get a better interest rate on the market. So the price of my fixed income declines. So it does make sense to kind of see an under allocation to fixed income, or I would say a low allocation, and potentially some cash to kind of manage that interest rate risk. But it is interesting to see, hey, how big of a problem is this? And okay, what tools at my disposal am I using to combat that problem?
Jared, I don't want to jump the gun in bringing this up, but we're talking about risk. As I mentioned, there are probably going to be different risks if you're thinking through, well, what's my greatest risk over the next 3 years compared to 23 years down the road? You really highlighted this in our notes, Jared. 43% of the global family offices surveyed really don't have a plan for the preservation of values, governance, legacy. And that really is the most important thing when trying to pass down wealth well. So if you're trying to identify what is the greatest risk 15 years from now, 25 years from now, well, the preservation of values in that falling through with your kids or grandkids, that's by far the greatest risk you face. And it trumps any sort of interest rate risk, any sort of private credit troubles that we're going to get into. That is the greatest risk. And again, I know we're going to spend some time on this, might be jumping the gun here, but if I'm thinking about long-term risk, are my kids and grandkids going to have the wherewithal to make great financial decisions? That's the biggest risk.
Right. And am I going to have the liquidity to let things do what they need to do over the correct time horizon? Right. Because one of the things about private investments is your money's kind of locked away. Right. So can I opportunistically deploy capital when the market's afraid? Right. Can I manage the capital calls and the distributions required for my family's needs? So I absolutely agree. It's like, hey, we have to focus on the wealth preservation, but also having a balance sheet that we can stick with for a decade, right? It doesn't matter if I picked all the best managers across private investments, if I need to pull money out of those at the worst possible time.
Yep.
Because I'm overspending, right? So that matters. Justin, you're touching on something important. I kind of want to pivot the conversation because it is fascinating, right? Like the family office is an asset allocation vehicle. And it's interesting to see, okay, how are they allocating money? How are they thinking about this? Cool, interesting. But it's also like, I want to spend a little time talking about, okay, the family office is a wealth preservation vehicle. And on page 35, it really kind of ties in the strategic priorities of a family office. And I want to read these to you because this is probably the most interesting chart that I saw in the entire thing. So 89% said, okay, their strategic priority was to manage liquid financial assets of the family. 76% said structure and coordinating estate and tax planning. 72% said sourcing and managing direct investments. 71% said financial administration and accounting. And 57% said preserving family values, governance, and legacy. Justin, that's inverted, man. If I think about like the hardest things to delegate, it's my family values, it's governance, it's legacy. If I think about the easiest things to delegate, it's managing liquid financial assets. Like as I look at those and how difficult it is for a family office to do this versus delegate it, I would actually flip the order of all of those and say like the principal function of the family should be preserving family values, governance, and legacy, financial administration, sourcing and managing investments, structuring and coordinating tax planning, and then managing the liquid financial assets. Why do you think, if we've identified this wealth preservation as like the principal function of a family office's existence, why is it the fifth most important strategic priority?
I think my first answer is that's a really good question. My second answer is probably because it's the single hardest thing to do. Again, the greatest risk to wealth being, preserved over 20, 30, 40 years, it truly is the makeup of your children and grandchildren. That's the hardest thing to produce. And so I do think it's inverted. Jared, I want to call out number 3 too. I think it's, and I don't want to be too extreme, but I think it's completely comical that the amount of attention, the priority, the strategic priority is so much more about sourcing and managing direct investments than preserving family values, governance, and legacy. And, you think about sourcing and really trying to make sure that you are vetting out and sourcing the greatest alternative investments. And we're talking about this in a time period where a globally diversified equity portfolio over about a 16-month time period has returned 40%. Like it's probably just completely trumped every alternative investment, and how much more attention is given to that than passing down legacies and values.
Yeah, I think there's two really important things here, right? Like if I think about why are these the strategic priorities, I don't think it's because they're the best things to focus on. I just think they have the easiest scoreboard.
Easiest.
Right? It's like if I delegate investment management, there's a benchmark I could compare you to. So I know exactly how you're doing day in, month in, year in, right? Like if I'm building infrastructure for family values, governance, and legacy, like I'm probably not going to know if these things are doing a good job for years and years and years. Right. So it's like it's kind of nebulous. It's kind of the fuzziest, right? So it's easiest to say, hey, let's attach the numbers first because it's really easy to see, am I doing a good job here? And, it's like, I would argue those functions matter, but they're not existential, right? Like the family values and governance, but it's just such an easier thing to focus on because I don't know, these things are fuzzy. How do I know if I'm doing a good job here?
Right.
What benchmark can I compare myself to?
That's so well put.
Cool. So I loved this because I think we're kind of introducing a problem with no solutions, right? We're like, and again, that's part of why this podcast exists. How do we preserve family values? What does good governance look like? What does legacy look like? And I love on this page of the report on page 25, it talks about some of the things that some of these families currently have in place to take advantage of this. They talk about a family constitution, bylaws, a statement of shared purpose and common objectives, family assembly, family councils, family retreat, written family history, or regular family storytelling, whole family meetings, chief learning officers, a family bank. Interestingly, all of these things that help with that fifth bucket of governance and values, none of these things more than 50% of family offices even adopted. So there's no one of these line items where more than half of the family offices surveyed have adopted these. Justin, does that surprise you? And do any of these tools really speak to you?
The biggest thing that pops out with this data is that you begin to see more and more when there's 2 generations, and then more and more when there's 3 generations involved in the family office. And so what that tells us, again, we're very early in this. A tremendous number of the family offices that have been created really within the last generation are kind of first generation, beginning to make these decisions. And so I think that they're just starting down this path, and they're kind of learning on the fly, and they're building this on the fly. What things can you do? Just like you said, there's not a perfect scoreboard. It's really hard to ascertain, am I passing down values well? And so biggest thing that pops out to me when you see multiple generations, all of these numbers go up for, are they doing these things? Are they having a written family history?
Yeah. I mean, it's also like, I think, getting back to what you're saying, where we are in the life cycle, it doesn't surprise me that all these tools in the tool belt are kind of underutilized. I would argue, right, it's probably tough to do these on your own, right? And like, there's probably some facilitation and outside benefit that might help. But candidly, I also think you just have to follow the incentives, right? If I want to serve wealthy families, would I rather be paid an hourly rate or a nice retainer to kind of go through this more existential stuff, or just charge an asset management fee and collect that? Right. So like, I think this alludes to A, the life cycle, we're really early, but B, also, I don't think there's a really deep bench focusing on these things, because there's a lot more money to be made in kind of some of the other, I would argue, less existential buckets.
Yep.
And it's just hard, frankly.
Right.
So if I'm a family office or if I want to build a wealth preservation vehicle and kind of pass down these things, I think the worst thing you could do is look at all these and be like, man, I need to do all these. I would focus on one and really say, okay, how do I implement this one? And which one makes the most sense for you really kind of depends on you and where you're at. Justin, I want to pick a bone and go back to investments for just a minute. I was looking at this chart on page 38, and it says, what asset classes are we leveraging outsource expertise in? The number one was U.S. public equities. The fewest was hedge funds at 44%. Again, I think there's some inversion happening, right? I think family offices are outsourcing the wrong asset class, right? If you think about the harder it is to beat a benchmark, the more efficient the market is. And U.S. public equities are infinitely more efficient of a market than hedge funds. So, the fact that people are delegating that kind of surprises me, but I think it alludes to this reality of, hey, family offices are early, and what's the easiest thing to get my arms around? It's, okay, public equities. So that's kind of where I'm going to start, and then I'm going to hire expertise. So I think like all of these points that we're talking through really point to this idea of like inertia. People are just kind of figuring it out and taking the next best step, while really failing to take a zoom out and figuring out, hey, how does this all fit together, and why does this even matter to me and my family? And so I think like a lot of these points show, hey, we're really early in the life cycle, and people are, I would say, fumbling through this. No shade, but I do think we're really just learning and figuring stuff out. And there's a lot where, we might be misallocating our attention just a little bit.
I think at the end of the day, we've alluded to this. It is really hard to staff out a family office that can focus on everything. If you just look at the investment universe, well, you could build a pretty substantial amount of staff that cover everything from U.S. public equities, which I think you and I look at that and think, why in the world are you devoting so many resources to the most efficient market in the world? And then, Jared, you can also go into the tax space, into the estate planning, the legal space, into more concierge services and property management. There are so many different things that you could devote focus to, devote resources to, and hire full-time staff to. And every family is coming with a very different balance sheet, and they're coming with different needs. And I think that is probably an entire topic in and of itself of how do you staff a family office? Who should your first 2 or 3 hires, who should they be? And, I think another question is there a maximum number of staff that you should have? I would argue that it could be a helpful exercise to try and limit that number. But I think that is kind of the ultimate reason why we see family offices going in so many different directions. It's really hard to kind of have a perfect textbook playbook of what should my infrastructure look like? How many staff should I have? At what point do I bring someone on full time or simply delegate it to a third party that is not under my roof? And all of those are tricky questions when every single family has a very different liquidity profile and balance sheet.
Yeah, yeah. It's easier. It's easier to solve when there's a scoreboard, right? Like it's easier to focus on investments if I have a benchmark to beat, right? It's like it's harder to think about the more existential things. Justin, I want to talk about what you're talking about related to the cost just a little bit, because I do think it's interesting, right? Like there is lots of money being thrown at these problems, but if you look at kind of some of the reports we've talked about, it's purely like it's a investment management vehicle with a side of governance, right? And ideally, the ideal family office is family governance with a side of investment management, right? So I think that's really where we need to go. And it's not for lack of resources, right? These different firms are very well capitalized, right? There's a page in here that looks at the cost of the family office. So, if the assets are $250 million or less, average family office is spending $875,000 a year. 250 to 500, $1.7 million a year. 500 to a billion, in excess of $3.2 million a year. And these are averages, right? And a $1 billion family office, $6.6 million a year. Does that sound about right to you?
I think it sounds in the ballpark of right, but Jared, I think I want to go back to our very first question. It is clarifying. It is very helpful if your first thought with family office is, I probably shouldn't start a family office. I probably don't need this, because if you're able to start with that thought, it will clarify, what do I actually need? What am I trying to accomplish? And it'll make sure that you're not in a situation where, you might have a $500 million net worth, but you're spending $10 million a year to have a family office operating.
Yeah. Beating an investment benchmark actually matters very little if you don't trust your kids, right? Or if you don't want them to get the money. So it's like really we need to refocus this. And again, I think this point of the cost of a family office alludes to there are resources and money being thrown at this problem, but I think it's, the emphasis is numerical and not existential. So, as we and kind of, I think that's part of why this podcast exists, because as we've kind of started to go on this journey, we've seen, hey, the money is a small part of what it means to build a legacy and to endure and to be successful and to have kids that you like and trust and understand what's going on and to continue in the direction that you've set forth. Justin, I know we kind of covered a lot here, but any other thoughts or ideas as we kind of wrap this up?
I think, Jared, again, it's just amazing when you look at 10 different family offices, you're going to find 10 completely different asset allocations, but especially 10 different staffing infrastructures. And so I'm excited to continue to explore, well, what's the right way to build out a family office? What staff are unnecessary? What staff provide the highest return on that investment? And there's just so many different kind of avenues and paths that we can take this down.
Yeah. Yeah. I think my big encouragement to our audience was, I think order of operations matters, right? Like, it's not like, hey, I'm going to set up a family office. It's like, no. What do I want true of me and my family's life? And then add the resources. Like, as I look through all this, it seems like you just kind of inertia just led you down this path of hiring these people. And you don't, you have the investment piece figured out, but you don't really have the family governance legacy stuff figured out, right? So if you're going on this journey, you're really even thinking about scaling this down to your own life, start with your why, which again is much harder to do, but I would say it's much more fruitful. Justin, I think that's a good place to wrap it up. Thank you, JP Morgan, for this report. I think there's a gold mine and a treasure trove. We'll be sure to link to it. And again, like, subscribe, share. Love hearing from our listeners, ideas for future episodes. We'll see you next time. Thanks.
This podcast is for informational purposes only. Nothing discussed during this show or episode should be viewed as investment, legal, and tax advice. If you have any questions pertaining to your specific situation, please consult the appropriate qualified professional.